What if I told you that the future price of gold does not depend only on mining supply, central bank buying, or inflation data, but on where the next war begins? What if the real signal for gold is not an economic report, but a missile launch? Right now, we are living in a time where geopolitics is driving the market more than spreadsheets ever could. And if you understand this shift early, you position yourself ahead of the crowd. Welcome to Gold Silver Scope, where we break down gold and silver not with hype, but with deep macro analysis in simple language. When forecasting gold prices, most analysts start with fundamentals. They talk about mining output, supply and demand, central bank accumulation, interest rates, and currency movements. And yes, all of those factors matter. But today, we are at a different stage of the cycle. We are at a point where geopolitical tension is acting like fuel on an already burning fire. The question is no longer just about inflation or money printing. The real question has become, where is the next flashpoint? Gold recently touched extremely high levels, briefly moving toward the $5,500 zone before experiencing a sharp correction down toward $4,800. Many weak hands panicked. Hedge funds sold aggressively. Momentum traders exited positions. On the surface, it looked like gold had peaked. But something important happened. The price recovered. Not slowly, not weakly. It climbed back toward $5,300 and even tested higher levels again. That tells us something critical. Strong markets recover from sell-offs. Weak markets collapse. Gold absorbed the selling pressure and came back stronger. That is not random price action. That is underlying strength. Volatility in a bull market is normal. In fact, corrections are necessary. They shake out weak hands and transfer metal into stronger hands who understand the bigger picture. Now let's simplify this, like explaining to a child. Why does gold go up during global tension? Because gold is trust. When people lose trust in governments, currencies, or stability, they run towards something that cannot be printed, hacked, or politically controlled. Gold is not someone else's liability. It has survived every empire, every war, and every financial crisis in recorded history. History shows us something powerful. Major global conflicts often revolve around energy. Oil has shaped wars for over a century. Countries fight not only for land, but for control of resources. Energy security equals national security. When energy supply is threatened, markets react. Oil prices move. Inflation expectations shift. Currencies fluctuate. And gold responds. If oil prices rise sharply due to conflict or supply disruption, inflation pressures increase. Central banks face difficult decisions. Do they raise rates and risk recession? Or do they tolerate inflation to maintain stability? In this environment of uncertainty, gold benefits because it thrives when confidence in policy weakens. Now look at the broader global chessboard. When tensions rise between major powers, supply chains become weapons. Energy flows become leverage. Trade routes become bargaining tools. In such an environment, gold is no longer just a hedge against inflation. It becomes a hedge against instability itself. Another key insight is how gold measures currency strength differently than foreign exchange markets. Many people say, the dollar is strong. But strong compared to what? If you measure the dollar against the euro, the exchange rate may look stable over long periods. But if you measure the dollar against gold, the story changes dramatically. When gold rises from $1,800 to above $5,000 in a few years, did gold magically become more valuable? Or did the purchasing power of currency decline relative to a fixed, scarce asset? Gold does not change. An ounce remains an ounce. What changes is the value of paper money measured against it. This is why long-term gold charts often reflect currency debasement more than gold appreciation. It is a mirror showing us the silent erosion of purchasing power. So when we talk about long-term targets like $10,000 gold, it is not about fantasy numbers. It is about the continuation of structural forces already in motion. Central banks around the world have been accumulating gold at record levels. Why? Because they understand something about systemic risk. They are diversifying away from overdependence on fiat reserves. That trend is not short-term speculation. It is strategic. Add geopolitical tension to that structural demand, and you have a powerful combination. Volatility will continue. There will be sharp drops. There will be moments when headlines scare investors. But if the macro environment remains unstable, the long-term direction remains intact. We are in a phase where gold is not simply reacting to economic data. It is reacting to global power shifts. And when the world feels uncertain, gold tends to feel confident. This is only the beginning of the bigger picture. In the next part, we will go deeper into how oil markets, currency measurement, and global power dynamics directly influence gold's trajectory, and why some nations benefit from higher energy prices, while others struggle. Now let's go deeper into the real engine behind this global shift: energy power and currency measurement. When we zoom out and look at the global system, energy sits at the center of everything. Oil is not just fuel for cars. It fuels transportation, military operations, manufacturing, food production, plastics, chemicals. Almost every modern industry depends on it. When oil prices move sharply, the entire economic structure feels it. History shows that major global conflicts often circle around energy access. When supply routes are threatened or production regions become unstable, oil prices react immediately. And when oil rises aggressively, inflation follows. Transportation becomes more expensive. Manufacturing costs increase. Food prices climb. That inflation pressure then pushes central banks into difficult policy decisions. Now think about what happens when central banks are trapped. If they raise interest rates too much, they risk breaking debt-heavy economies. Governments today carry massive debt loads. Higher rates mean higher debt servicing costs. But if they do not raise rates enough, inflation can spiral. This creates a policy dilemma, and gold performs strongly during policy dilemmas. Gold thrives when confidence in monetary management weakens. It moves not just because of inflation, but because of uncertainty about how inflation will be handled. Now let's connect oil geopolitics directly to gold. When tensions rise in major oil-producing regions, markets immediately price in risk. Even the possibility of supply disruption can push prices higher. Higher oil prices benefit oil exporters, but they pressure oil importers. This creates shifts in trade balances, currency flows, and geopolitical leverage. For example, when oil prices rise significantly, exporting nations gain stronger revenue positions. Importing nations face currency pressure because they must spend more of their currency reserves to secure energy. That can weaken their currencies internally, even if foreign exchange charts do not immediately show dramatic changes. And here is where gold becomes the true measuring stick. Many people look at currency indexes like the dollar index and say, the dollar looks stable. But these indexes mostly measure one paper currency against other paper currencies. If all major currencies are being managed with expansionary policies over time, comparing them to each other does not reveal the full picture. When you measure currency against gold, you are comparing it to a fixed physical asset with limited supply. Gold cannot be printed. It cannot be digitally created. Its annual supply grows slowly through mining, and mining itself requires capital, energy, and time. So if gold triples in price over a few years, we must ask a serious question. Did gold change? Or did currency purchasing power decline relative to something fixed? This perspective changes how you interpret price charts. A rising gold chart may actually be a falling currency chart. Now let's talk about winners and losers in a high-energy price environment. Countries that export large amounts of oil benefit from higher prices. Their revenue increases, their trade balances improve, their fiscal positions strengthen in the short term. On the other hand, countries heavily dependent on imported energy face pressure. Manufacturing costs rise, consumer prices increase, economic growth can slow. This imbalance creates global tension. Energy becomes leverage, trade relationships shift, negotiations harden, and markets respond to that instability. Gold is highly sensitive to instability. It does not need war itself. It only needs uncertainty. It only needs rising tension. Even strategic positioning by major powers can move gold higher if markets sense increased risk. Another important factor is central bank behavior during geopolitical tension. When global uncertainty rises, central banks often accelerate gold accumulation as a reserve diversification strategy. They understand that during crisis periods, liquidity in some financial assets can dry up, but physical gold remains universally recognized and tradable. We have seen record central bank gold buying in recent years. That is not emotional behavior, that is strategic positioning. Now consider this scenario. Energy prices remain elevated due to geopolitical risk. Inflation remains sticky. Central banks cannot aggressively tighten because of debt constraints. Governments continue fiscal spending to maintain social stability. What happens to real interest rates in that environment? They remain pressured. Gold historically performs well when real interest rates are low or negative. If inflation is high and nominal interest rates cannot keep pace, the real return on cash becomes negative. Investors then seek protection in assets that hold purchasing power. Gold becomes attractive. This is why corrections in gold during strong macro trends often become buying opportunities rather than trend reversals. Short-term traders react to headlines. Long-term investors analyze structural forces. And structurally, we are still in a period of high geopolitical tension, energy leverage battles, and currency management pressure. All of these forces together create a supportive backdrop for gold over the long term. Volatility will continue. There will be sharp price swings. But as long as uncertainty remains embedded in the global system, gold retains its strategic importance. Now let's bring everything together and talk about what this means for long-term price direction, investor psychology, and realistic expectations for gold and silver. When markets move toward extreme levels, most people focus only on the number. They hear projections like $10,000 gold and immediately think it sounds dramatic. But serious investors do not focus on the headline number. They focus on the forces behind the number. If currency purchasing power continues to decline relative to hard assets, if geopolitical tension remains elevated, if energy markets stay weaponized, and if central banks continue accumulating gold at historic levels, then higher long-term gold prices are not extreme. They are logical. But here is something very important. A bull market does not move in a straight line. It never has. Even in the strongest historical gold rallies, there were violent pullbacks. There were 10%, 20%, even 30% corrections along the way. Weak hands panic during those moments. Strong hands prepare for them. When gold briefly moved toward $5,500 and then dropped sharply toward $4,800, many people assumed the move was over. But what happened next? The market absorbed the selling pressure and recovered back above $5,300. That tells you something powerful about underlying demand. Markets that are ready to collapse do not recover like that. Volatility is not weakness. In strong macro trends, volatility is fuel. Now let's bring silver into the discussion. Silver behaves differently from gold in some ways. It is both a monetary metal and an industrial metal. That means it benefits from monetary instability like gold, but it also benefits from industrial demand, especially in energy transition technologies, electronics, and manufacturing. When gold moves strongly, Silver often follows with higher percentage moves, but also higher volatility. Silver tends to lag at first and then accelerate. That is why experienced investors watch the gold-to-silver ratio closely. When that ratio starts compressing, it often signals silver outperformance. In a world of rising geopolitical tension, currency uncertainty, and structural inflation pressure, both gold and silver remain strategically important. But positioning matters. Emotional buying during spikes and panic selling during pullbacks are the most common investor mistakes. Let's also talk about psychology. During uncertain times, fear drives markets. But fear creates opportunity for those who understand cycles. When headlines are loud and dramatic, the smart move is not to react emotionally. The smart move is to evaluate whether the long-term thesis has changed. Has global debt disappeared? No. Has geopolitical tension suddenly ended? No. Have central banks stopped buying gold? No. Has currency purchasing power suddenly strengthened relative to gold? No. If the structural drivers remain intact, then the long-term direction remains intact, even if short-term price swings feel uncomfortable. However, responsible analysis also means acknowledging risk. If geopolitical tensions cool dramatically, if energy prices stabilize for extended periods, if real interest rates rise significantly and remain positive, gold could face longer consolidation phases. Markets are dynamic. Nothing moves forever without pauses. That is why strategy is more important than prediction. Long-term wealth building in precious metals is about disciplined positioning, not chasing headlines. As we move forward, watch three key indicators: geopolitical escalation points, real interest rate trends, and central bank gold accumulation data. These are deeper signals than daily price noise. If you found this breakdown helpful and you want clear, simple macro analysis on gold and silver without hype or emotional noise, make sure you stay connected with Gold Silver Scope. This channel is focused on understanding the bigger picture so you can think independently and position yourself wisely. And one final important reminder: this discussion is for educational and informational purposes only. It is not financial advice. Always do your own research, understand your risk tolerance, and consult with a qualified financial professional before making investment decisions. In times of uncertainty, knowledge is your strongest asset. Stay informed, stay disciplined, and think long-term.